Hey everybody, James Nutter here from I Am Wealth. Did you know that 3 of every 4 American families say money is their number one household stress? That means 3 of every 4 of your friends say money is their number one household stress. I too have felt it. I imagine you have felt it. Otherwise, you wouldn't be here right now. So that's why we created the I Am Masterclass, a safe space for you to learn with your friends and families how to take control of your money without making critical mistakes. And so thank you so much for being here. And please visit us at iamwealth.com. We offer free financial wellness diagnostics, have a bunch of great resources on there for you. And without further ado, let's jump into the masterclass. Welcome to yet another episode of the A Life Well Lived, a Physician's Guide to Wealth Masterclass, brought to you by James and Jeff at I Am Wealth and the I Am Wealth team. I'll be your host, James Nutter, partner and financial planner from I Am Wealth. And today our focus will be on easy for me to say, physician 1099 deduction hacks and the deductions you don't know you're missing that could potentially cost you thousands. We did a previous one about a couple of weeks ago where Matt joined us and we talked about structural mistakes, 1099 S Corp versus LLC, et cetera. So we'll actually have that recorded. It was recorded and will be released to you guys soon here. So I always like to start by just naming the problem and why we created these masterclasses. So 3 of every 4 American families say money is their number one household stress on the home front. Add to that 42% of physicians report burnout year after year, according to the Medscape study. I'm sure all of you are very familiar with that. And a lot of that burnout can derive from lifestyle, money, different types of things. I know a lot of it comes from workplace pressure and stress and long hours and seeing a bunch of patients and things like that as well. TD Ameritrade did a study and found that 41% of divorced Gen Xers, along with 29% of divorced boomers, state that the reason that their marriages ended was due to financial disagreements. And add to this that CNBC did a study that 54% of people believe a partner with debt is a reason to consider divorce. Ouch. So there's not a ton of real world money education out there. I studied finance and accounting in college, and a lot of it was very formula based. It was not like personal behavioral finance and how to make great decisions with your money. Especially for you as physicians, there's a ton of internet gurus with a bunch of rule of thumbs telling you to live like a resident and follow all these crazy algorithms and 10, 30, 20 budget systems or whatever the heck it is. And at the same time, we all live in this like Instagram, keeping up with the Joneses economy, where we compare and contrast one another. We judge the person getting out of the Porsche, just like we judge the person getting out of the beater. And yet as a society and culture, we never talk about money. So that is why we created the I Am Wealth Masterclass, a safe space and place to learn about money and for you and your family to learn how to make healthy decisions and live your most meaningful lives. We understand you all live and lead busy lives, so we'll try to get you in and out of here in about an hour today. And just a little bit more about us at I Am Wealth. We're a fiduciary financial practice, and we currently help 95 physician and affluent families take control of their money. And for all others like you here right now, we try our best to give away a ton of value for free, hopefully better than some paid online program that you could go buy or some rule of thumb Google search doing things like this 100% for free. And this is really for two reasons. One, just to provide you that real world financial wellness that you deserve. And then second, hopefully just earn your trust. We want to put stuff like this out there for you to earn your trust over time. And if maybe someday what we do for you for free helps, and you get to a place where you feel stuck, that someday we could be there for you to maybe help you take it to that next level. And for everyone that has registered for this class, just to reward your proactivity, we offer free financial wellness diagnostics. It essentially would be like going to a primary care physician for the first time and them doing blood work, vitals, everything, and giving you your baseline of health. You have to be for your money and it'd be 100% free. And that's something that we just do to reward everybody who's here right now. This was sent out to every physician at ERG amongst other groups, and there's 5 of you here. So just keep that in mind. We respect those who actually take time to show up. A few quick ground rules. We just commit to no cost and no sales in this. We're not going to talk about specific products, specific investments, anything like that. And because of rule number 1 and number 2, we commit to no bull. You can use your wildest imagination for that. And a quick disclaimer that I must throw in is I Am Wealth does not offer individual financial advice outside of a formal fiduciary consulting agreement. Content discussed today is not and does not represent any financial, tax, and or legal advice. The intent of the masterclass is to provide extremely valuable educational content for free. For personal questions, we hope you'll visit us at iamwealth.com. You can you can email journey@iamwealth.com and send us your questions, or you can book one of those free financial wellness diagnostics directly on iamwealth.com. In the top right corner, there'll be a button that says join, or in the bottom right corner, they'll say something, book a free financial wellness diagnostic, and it'll take you directly, I believe, to my calendar. So happy to be there for you. I want to give a brief introduction and shout out to Jeff McPherson CFP, the founder of I Am Wealth, and Jeff played football with Jason Bunce. For anybody from the ERG community that's on here that knows Jason, and back in their glory days when they probably were moving a bunch of weights and having a great time together. And then we also have Matt Barczak, who is our in-network go-to CPA for a majority of our I Am Wealth clients. Matt claims that he played very poor college basketball, but he can still dunk. So everybody just, keep that in mind when you're thinking about him talking today. But he focuses on helping medical tax with practices and then also individuals. He works with about 50 practices and 175 physicians. So the general flow today, we're going to start with just kind of some fun questions to ask Matt about everything relating to deductions and how to work with a CPA, things like that. And then we're going to talk about hot topic deductions, and essentially go through a list, whether it's solo 401ks or the Augusta rule or putting kids on your payroll or whatever it might be. We'll sprinkle in a few potential case studies in the mix. And then we want to hear from you guys too. So we'll open it up to some Q&A at the end. So Matt, thank you very much for being here. Welcome. And anything
I'm trying to figure out, so I'm looking at both of you guys, and I'm trying to figure out how you're sitting in the same chair with the same background, but
yeah, come get
something
in my
doesn't
arm,
add
up. You caught us.
Jeff just has, these fantasies of this dream office, right? So it's a work in progress, and technology is pretty wild. But Jeff, you want to hug it out? All right, I'm just.
Yeah, the best part about the background is the subtlety of the computer screen that shows like a stock chart just going up and to the right. It's very discreet, very suggestive, right?
Subliminal messaging.
Oh, it's good.
Oh, that's funny. So let's jump in with a few questions. And Jeff, if you thought of any additional ones, throw them out there. I know we brainstormed a few in advance. And I also forgot to mention, for anybody that's listening on like the internet or the web, thank you. And for anybody that's here, this will be recorded and we'll get it to you once it gets approved by our compliance team. Hi, compliance team. When you're listening to me in the future, I just time traveled. So Matt, what are some of the most crucial mistakes you see 1099 physicians make as it relates to their deductions?
Now we're going to get into all kinds of different opportunities. The biggest thing the biggest mistake I think people probably make is not caring enough. So they take, okay, I got a 1099 at the end of the year for, we'll call it 300 grand. We'll put it on my tax return. If I can think of a couple loose write-offs, I'll put on there, reduce my income tax a little bit, and then I'll file my return. But, if you care a little bit more, put forth a little bit more effort, reach out to some consultants. I mean, you can save thousands of dollars a year in income taxes, right? And, also do some family planning, legacy planning as well in the meantime. So I'd say that's probably number one, is just people want it done and over with, don't want to have to deal with it. So they just put it together and move on.
Okay, cool.
Does that make sense? Yeah. Hopefully.
Yeah. Oh yeah. I mean, absolutely. I mean, I personally have been there. Like, you just get busy and you're like, holy crap, taxes. I don't like taxes. And you just don't do it. So, and I do this for a living.
So you can have the same thing go on with a professional too, where you provide them with a 1099, a couple business expenses, and get a product back. That's not how we work, and that's not how most CPAs should work. It should be a more of a relationship and a communication to where, okay, if I receive some information from someone, I'm going to come back at them and say, okay, I received a couple of pieces of information, but what about XYZ, right? Let's expand on these deductions and make sure you're not paying the IRS and or state too much.
So when you say a product, are you referring to there's, I'm thinking immediately of like TurboTax, right? But like just get it, get it inputted, get it done. Or there's probably some CPAs out there that basically they just will like do your return. Is that kind of what you're referring to versus actually being strategic with you? Okay.
Exactly. So that's what you would call compliance focused. And we try to frame ourselves more as advisors or consultants as opposed to CPAs, tax preparers. We're not here to just provide a tax return, right? It's a lot more than that.
Okay. Well, I know one of the questions we were going to ask, Jeff, were you going to say something?
No. I guess the other thing that I was going to say is also too, and it's like I feel like we've been through this before too. You don't know what you don't know, so sometimes you learn by making mistakes and missing opportunities for years go by, and you learn. But that's a huge part of what we're here to talk today about is some of the things that maybe some people on here already know all of these deductions that we'll discuss today, but just things to start thinking about to not have to miss out on the opportunity.
Mm-hmm.
Yeah.
Sounds like me in the home improvement world, right? I'm doing stuff around my house. I'm making more mistakes than doing things correctly, So that's probably people with finances, or a lot of people with finances and taxes, especially.
Absolutely. Or me trying to be my own physician during a medical crisis or whatever.
That sounds like a catastrophe to me.
Me too. Same with home appliance as well. I know that one of the questions we were going to ask you, and maybe it already has been answered just by how you just answered it, is what have you seen as the difference between a successful professional relationship with a CPA for a physician and an unsuccessful one? So maybe is that kind of what you were alluding to? Anything else that you want to add to that?
A little bit. I would say even taking that a step further is having a deep relationship, but also connecting with professionals that want to educate, not just provide, like I said, a tax return back, but educate you, James, Jeff, whoever it may be, and say, okay, here's how the process works. Here's the layout of your tax return, and here's specifically what your profit and loss looks like. That way, both people understand the situation, and more importantly, when the client understands and is educated on the situation, they're going to ask more and more educated questions and know when to ask those questions along the way too.
Okay, so it's having a CPA that's more educational and actually informative and like back and forth, probably collaborating with key advisors too, like other financial planners or business attorneys or whatever it might be as well.
Yep. Hands-on. Yeah, I actually engaged with this was a counseling practice, but when I first met with them, I met with the entire board. I think they had like 10 people on the board, sat in their conference room with them, and we were just bouncing ideas and talking about different things together. And the president looked at me and said, "Thank you so much for coming out here. Our prior CPA, I've actually never met in person, and I've only talked to him a couple times on the phone in the last 12 years. I'm like, there's something truly wrong with that picture.
Absolutely. Yeah, that's so great. So great. Doesn't surprise me. I know there's a lot of financial advisors who just gather assets and then never talk to their clients either. So we see that all the time in our industry. Set it and forget it. So basically surround yourself with a capable team to help you take it to the next level. Just like I would surround myself with, a primary care physician, nutritionist, trainer, all the different things as it relates to like medical and my personal health. Love it. And then what is something, I know we're going to go through a lot here in a second, so maybe it's hard to answer this question directly, but what is something a listener could just take away from today and immediately implement into their life? I'm all about, and for everybody listening right now, if you're taking notes, or I would encourage you to take notes or even just pull out your iPhone and get the notes app going on your phone. Don't end up on Instagram or anything like that. That'll be a waste of your time. But I'm always about like write down, at the end of this, write down 1 to 3 things that you can take action on in the next 24 hours. no matter what it is. But Matt, is there anything, I know we're going to go through a lot. It's probably hard to say like one particular thing, but anything that a listener you think could take away today and immediately implement into their life?
Well, hopefully there'll be more than one. And, a lot of these opportunities are dependent upon the individual situation. So each individual might leave here today with a different takeaway, right? But I would say the biggest thing is to have a plan and be intentional. So evaluating these different opportunities and trying to apply them to your situation and follow through with your plan.
Love it. Absolutely love it. Love the word intentionality. Jeff, anything that you want to add at this point, or do we want to jump into some hot topic deductions? Or Matt, anything else you want to?
Yeah.
Cool. Okay, sweet. Yeah, let's jump into some of those hot topic deductions. These actually came from some of you guys. Like we did another one of these webinars back in April, and there was like a list of when you guys all registered of deductions. So we're kind of pulling directly from the audience and implementing them in here. So Matt, we'll hand you the floor, and we'll kind of do a open roundtable and see what happens here.
It's more or less for everyone watching is almost like a roundtable discussion. We'll talk about essentially a list of different hot topic expense line items, deductions. And Jeff, James, or even anyone on the call, feel free to bring up some opportunities too. So we have a list of, I don't know, maybe 10 to 12 different opportunities here that are common ones, but we can veer off in any direction anyone else wants. So
Matt, do we have the ability to go in and like in your little software, like you've done in the past, to go in and illustrate like the impact of it, or would you rather not do that today? If we wanted to do like a little mini case study.
Probably not today.
Okay.
As far as the impact goes, we can realistically just do it on a calculator, to be honest.
Okay. Cool.
So if we have round dollar amounts, we can just do a rough tax on that dollar amount and come up with tax savings and do it that way. Or even if we wanted to plug it into a calculator of future savings based on X number of dollars of savings per year kind of thing with a certain rate of return, we could always do that too. But
I'm sure Jeff has his time value calculator in his pocket.
That's fun.
All right. I love it.
I always love to see those opportunities.
It's like a sword, There you go.
Oh, that's funny. Okay, Matt.
The first one on my list is actually, and this might even be the most understood or misunderstood items out there, is vehicles. Vehicles can be a significant challenge for physicians or people who work on a 1099 basis to write off. And the reason I say that is because the general IRS rule for vehicles and vehicle expenses is, if I work, so let's just take my work, for example, just because it's easy. I work at one location, right? I actually do work at a couple different locations. We can expand on it a little bit more, but if I work at one location primarily, and even if I'm on a 1099 or W-2 basis, it doesn't make a difference. When I travel from my house to this location, it's about 15 miles away, that trip is considered commuting expenses, and those are non-deductible, right? So in order to create a deduction out of vehicle expenses, we have to, one, travel to another location other than that primary location. So if we work for multiple hospitals, for example, or if we have a meeting with a professional at their office, or we need to go to the store for supplies, different things like that. We need to look for other opportunities beyond just that direct commuting to the hospital, right? Another common area that we see some opportunity is, I have a neurologist client, and he sold his practice, and he's essentially working from home now, and he's reading images and providing an analytics or analysis on those imaging. And what he does is anytime he leaves his house to go somewhere, he can now write that off because his house is now his primary work location. So technically there is no such thing as commuting for him because he can prove that he works the majority of his time out of his house. So it's really where your primary work location is that the travel from your house to that location is considered commuting. So we'll oftentimes have conversations with clients of, okay, does it make sense for me to put a vehicle on my books, right? Can I expense or write off a vehicle? And I really have to evaluate the situation at hand for that person. Are they working for multiple locations is probably the number one question. If they're working for multiple locations, I say, yeah, absolutely, we can do that. And for vehicles, there's an accelerated depreciation or an upfront deduction or write-off. And we can really get a significant tax advantage in that first year of purchase for a vehicle to where it can eliminate quite a bit of tax. But again, if the individual has 99.9% just commuting expenses back and forth, okay, it probably doesn't make sense for you specifically. Let's maybe look at doing a mileage deduction instead for anything that falls outside of those commuting expenses. So a mileage deduction would be taking your number of miles on your personal vehicle driven to anything other than your primary work location. So if it's travel for a conference or anything else, we take the number of miles and then you multiply it by the IRS standard rate. The IRS has a standard rate they use for miles on an annual basis. I think it's maybe 64 or 65 cents per mile, something like that. Does that give you a good summary on the vehicle topic, or did that bring forth more questions?
Makes sense to me. It's interesting that the commute isn't deductible. You'd think that it would be. But
especially as a 1099 individual, right? You're not given any vehicle or anything like that. It's essentially out of your own pocket to have to make it there. But if you're only working for one location, that provides it makes it difficult because then it's commuting.
Yeah, that makes sense. And if we want to keep going through the list, I would feel okay with that, just so we make sure we get through some of the more like the hot topics. And I guess we could save Q&A for the end. But if anyone has a quick question, I'd say, we got a small group here, feel free to jump in.
Yeah. And I think another thing too with the car stuff would be, and maybe that's more of a personal thing to squeeze into, like a one-off email / one of those wellness diagnostics to say like, hey, what's the best path for me to take as an individual? Should I as a human buy the car and lease it to the business, or should I lease a car with the business? Like all those different, who's paying for what to be able to get to where you're trying to go. That's probably a unique tax advice conversation for sure. But we see that pretty regularly, right?
I would be glad to connect with anyone too. On their specific situation. No problem at all.
Matt, cool. What's your email for everyone listening in case they did want to reach out to you for one of those, like a free consult with you?
Yeah. You want me to just toss it, or is chat disabled?
Yeah, compliant.
It's Matt.Barczak. So my name there on the screen, Matt.Barczak @Raymond.com, REHMANN.
Awesome. Cool. All right, what do we got?
The next piece I think that's a great one to go to is family payroll, right? So this can be a huge one, and it provides a whole lot of different avenues to do different things. And again, it depends on your specific situation, and the main goal would be to find opportunities for yourself to put family to work. Or another opportunity is to utilize family images, pictures, what have you, for either marketing or to portray a certain image for either your the hospital you're working for, or patients, whatever it may be. So you're paying for, we all here right now NIL, right? When it comes to athletes, you're using someone's image. It's hard to quantify when you use someone's image for something, right? So if we're using our family's image and we're paying them for that, it's pretty difficult to contest the dollar amount there. But that being said, so if we, let's say hypothetically, we have James or Jeff here, you guys are both 1099 basis and you're sole proprietors, right? Sole proprietors are naturally reported on a Schedule C on your individual income tax return. And you don't naturally have to have payroll, right? You don't have to pay yourself a W-2 wage. So if we were to pay family members, we would have to set up payroll. So there's some extra compliance that goes along with that, to where you would have to engage a third party to help you facilitate the payroll. So one is the check has to leave the LLC bank account and go to your individual bank account, or, the child or spouse's individual bank account. And then secondarily, the payroll company takes care of remitting any withholding taxes and filing any quarterly or annual tax returns, payroll tax returns. So that's logistically what that looks like. There's an extra administrative cost of having that payroll, right? So we want to make sure that, hey, it's worth it. Well, if you get down into the numbers, we can technically pay any individual $12,000. I think it's a little over $12,000 now with inflation, but we'll use $12,000 for rounding purposes. We can pay any individual $12,000 per year, and they don't have to file an income tax return. As long as you earn less than that number on an annual basis, you're not required to file, right? So I'm talking about, a child that has no other job. So one, we have a $12,000 expense to our LLC that we can write off. So hypothetically, let's say we're in a 37% tax bracket, right? Or that's the highest IRS tax bracket. 37% times 12,000 is what? Jeff, you do the math to see what that savings.
4,440.
Man, you're quick, James.
I knew where you were going.
So $4,400 is the tax savings, but now you can take that 12,000, right? That's earned income for the child. The child now can contribute up to the Roth maximum limit, which is what for 2024? Is it up to
7,000? Yep.
Okay, so $7,000 they can contribute to this Roth, which is an after-tax account, right? So now you have $7,000 that is, when they retire, is tax-free. The IRS, there is no reporting on those Roth accounts. They can take it out, after retirement whenever, and there is no tax paid on it. Plus, you were able to deduct $12,000 because it was an expense. The key being, in order to be able to make a Roth contribution, you have to have earned income, right? So the only way to make a $7,000 contribution, you have to have at least $7,000 of earned income for that individual. And the W-2 qualifies as earned income there. Another piece that expands on the opportunity too, and this almost goes back to the structural questions we got into in the last class a couple weeks ago on the S corporation versus just a sole proprietorship or a single member LLC on your individual income tax return. If you are a sole proprietorship, you actually have your Social Security and Medicare taxes for a child employee, and it's exempt from payroll taxes. For an S corporation, that is not the case. It's still subject to those payroll taxes. So that's 7.65% times 2, because you have to pay the employee and the employer side for that, right? So that's another significant savings if you're simply reporting your 1099 income on your Schedule C or your individual income tax return, and you're employing a child. So hopefully I know that was a lot of information thrown out on specifically the children on
good.
payroll piece, but I think that, go ahead, Jeff.
One really cool thing on that, I just had the calculator out here, and even if you're just looked at 1 year, let's just pretend we're talking about one child, and you take $7,000 in 2024, and you put $7,000 into the Roth IRA this year. Let's pretend they're 12 years old, and then we deposit that in Roth IRA, and then let it sit there for 50 years, putting them at age 62. If we average 9% per year on average rate of return, that ends up being just over $520,000 in that account.
$7,000, man,
yeah.
Jeff.
Pretty cool, right? So that's just 1 year. That's not like every single year maxing it out. That's 1 year, but it's just, that's the power of starting it early, right? So
and that's 12 years old. That's wild. Yeah. You know what's a bunch of crap, Jeff and James? I don't know about you guys, but I didn't have a mom or dad deposit $7,000 into an account for me into a Roth when I was 12 years old. I should be sitting on, halfway to that $500,000 right now.
There you go. Yeah.
Yeah. That's hilarious.
Yeah.
Yeah, that is wild.
And not to mention also that doesn't count the tax savings on mom and dad's side, right?
Yep.
Which if you also compound that, that's obviously significant for their side as well.
Matt, what are some other things, like if they, that with that 12,000, I know we had talked about like you could put it into a 529 account, like other things that you could strategically do with it. You want to touch on any of that at all?
Yeah, 529 can be one. With a 529, you don't have to have earned income. So the $12,000 doesn't necessarily need to be for a 529. It can come directly from the parents in that case. It's essentially treated as a gift, right? So you want to go up to the annual gifting exclusion amount. So the 529, you could definitely do that. You could also fund like an UTMA account or something like that. The key here, you would want to prevent too many investments for the child, because of the fact that you don't want a significant amount of unearned income for them that would trigger a filing requirement, because the unearned income amount is much lower than that $12,000 of earned income. So if they have unearned income of like $4,000 per year, now all of a sudden that's triggering a filing requirement. So that's something to balance, keep some of that money out of, more or less their name so that it doesn't trigger a filing requirement. But yeah, 529 and Roth are both great options for that.
Awesome. Yeah. And then I'm sure people are wondering, like, okay, if I employ my kid, like, what do they have to do? So I know there's a variety of different things they can do. Is it hard to prove to the IRS or your CPA of like the things that they're doing, or is it quite simple, or what does that look like for people that you've worked with?
It really just depends on the agent, the IRS agent you get, but I have not personally had one that was nixed. Another one of my partners has had family earnings reversed, and he's like, yep, I had it disallowed by the IRS and I started it right back up the next year. But as far as roles, I mean, you just have to look at your individual situation and find a role for them, right? If it could even be home office cleaning, right? Your home office that you work out of needs to be cleaned. I mean, it's something very basic. Or, I have certain individuals that have family pictures that they have up when they're, having meetings, whether it's a background on a Zoom or even in their family office or whatever, they have family pictures up, and that's how they justify paying family. Or website is another one. I have essentially a mobile emergency veterinarian, right? And she has her own website and she has her family on her website, right? So that one to me is a pretty easy one if you have pictures of your family on your website. for marketing purposes,
And because of NIL, you can basically just do that.
Right. Yep.
That's so interesting. Huh. Crazy. Cool. All right. Anything else on that one, or should we move on to another hot topic? You think that was all awesome? Thank you for doing that.
I think one thing that might be cool is talk about like even just real world kind of family scenario, just to tie all of that stuff together into like a real story. Maybe just to paint a little bit more of a comprehensive picture about how it can work, if that's okay. So
yeah, for sure.
we have, and actually just had a meeting this morning with this couple, but got a couple, and actually emergency medicine couple, and one spouse is transitioning into that 1099 world and forming the entity, going through all the different planning steps right now. The spouses both have an income, right? So that was part of like, the first session that we had on this was figuring out how to structure the entity based on the dual income of both spouses. And one of the things that's really unique here is that the physician's spouse does work, but limits their work to part-time, basically working enough to max out a retirement plan through her employer. And so maxing out a retirement plan, physician spouse is going to be maxing out, we're kind of landing on what type of retirement plan to design for them, because they're going to involve both spouses and both are going to participate in that future retirement plan. So they're going to be able to be in a position to kind of like double dip. They'll be participating in that employer plan over in their part-time work, but also participating with an active role in the medical business as well. And so they'll be able to participate in the profit sharing component of that. So another really cool thing there with them is they have 2 children that will play an active role, and they already put money into 529 plans for both children, but now they're going to be doing it via payroll. So it's going to save them a lot of tax, but they're going to be able to do the same things they're doing already with in an after tax kind of like situation. But the thing that's really cool for them is most of the new things they're going to be doing are it's just like the same type of motion, but paying significantly less tax to do it, while also getting more. They're just looking forward to having the children learning about business by participating in the business and getting paid and doing all those things. It's another thing too that we see with clients is that they enjoy getting their kids involved, because it gets the kids learning about some of these things that none of us learned about when we were kids. So
absolutely, it's more than just the money. Life principles for the kids too. It's a great story.
Yeah,
that's a great story. And to expand on that a little bit more, if I was in their shoes, right, I would prioritize even more the Roth component of that. So if you're paying $12,000 a year and you say, okay, I want my kids to get this $12,000, whether it's via a 529 contribution or a Roth, right? $12,000 will go into one and or both of those accounts. Do the $7,000 to the Roth first, and then the remainder into the 529. And the reason I say that is because we have the ability to do both, but the 529 contributions are subject to additional limitations when you pull it out. If you pull it out for non-education related purposes, now all of a sudden that becomes taxable, right? The earnings are taxable at that point. So it's better to do a Roth first and then the 529, because the Roth is not subject. Yeah, it's subject to some age limitations instead of the education limitations, but you won't be taxed on it is the key.
Right.
That makes sense.
And it's cool for them in that situation. They're going to be doing both, which is really exciting for the family, because they're able to basically take a pretty similar amount of gross earnings that was required to in the past, put money into 529 plans and use that tax savings to fund Roth IRA and 5, because they're paying children rather than having to earn basically 1.4 multiple of the, like the net that's needed to put away. They're not having to pay that extra in tax to eventually save this exact same amount that they're going to
Right. Take the after-tax dollars to contribute into those accounts. Yeah, you need an extra 40%. Yeah.
Yeah.
Love it. That might be a good segue. Should we move into some of the retirement plans? I think that might be a perfect segue.
Yeah.
I agree.
Retirement plan deduction mistakes. What are some common mistakes? What do we want to talk about here, Matt? Let's do it.
I'd say common mistake on when you're being paid on a 1099 basis is just not realizing you have an opportunity to contribute to retirement plans that are different than other individuals. And, some people even limit themselves to just IRA contributions, right? So, okay, well, as an individual, I can contribute to an IRA, but when you're paid on a 1099 basis, you have self-employment earnings, and those self-employment earnings free up the opportunity to fund a few different types of accounts, whether it's a SEP account or what we also see commonly is a solo 401k account. And the difference being on a SEP account, you just take the bottom line net income at 25%. You have to back off that expense as a deduction. It's kind of a circular equation, which is kind of a pain in the butt. But essentially, for ease of this conversation, 25% of your net income, whereas solo 401k, you got the employer contribution, employee and employer contribution, and then the 25%. So depending on your individual situation, the solo 401k might be more advantageous for you, or, the SEP account would be.
Are there any 1099 income limits? So if, I'm sure there's people on here that like full-time W-2 and then they do locums on the side or moonlight on the side. Do you have to be making X amount as a 1099 to be able to do it? Or can any dollar amount, you can just open up and do it?
Any dollar amount. I mean, at that point, administratively, you don't want it to be a burden. If you have a net income of $1,000, you contribute 25% of your $1,000, you're contributing, $250 into an account. That's not going to be worth it for you, right?
Yeah.
So, but yeah, you're eligible at any point.
Okay. Incredible.
Yeah. And the beauty now is you actually have up until the due date of your extended due date on your tax return up through October 15th to fund these accounts. So if you're sitting here on July 10th, you haven't had your tax return filed. I actually sat down with a prospect yesterday, and they're like, I haven't filed for 2023. I have $300K of 1099 income. I didn't pay quarterly at all. Okay, a great way to minimize the penalties and interest you're going to be getting is to fund a SEP account. And the IRS just expanded this rule a couple of years ago. You used to have it set up the year before, but now you can set up a 2023 account by the due date of your tax return.
Interesting.
Yeah, it's wild, but very beneficial, especially if you're a procrastinator and you want to eliminate some of that tax.
Yeah. And there's definitely some good gamesmanship that can be played with this too each year as James, as you had mentioned, and there may be people on here, but we definitely have a lot of clients that have, maybe the majority of their income may be W-2, but they've got a pretty sizable amount of 1099, but maybe it's not a massive amount, but I have the calculator pulled up right here that can just kind of help illustrate the point. Let's say if somebody has a lot of W-2 and they're picking up their total net profit on the 1099 side. So we've got our gross income minus our expenses, getting to, let's say, $50,000 of net 1099 earnings. We calculate
Jeff, are you able to zoom this in at all? No worries if you don't know how.
Yep. Is that better?
Oh yeah, perfect. Keyboard wizard.
So now this is just going to show us like, a quick dirty little side-by-side comparison of how much you can put away into a solo K versus a SEP, right? And so, if somebody's right, like if you have just a small amount of your income relative to your total income, if it's 1099 is the smaller amount, ideally, let's try to drive that down. And I guess everybody's situation is different, right? So maybe this doesn't work for everyone, but if we can drive down that 1099 earning as much as possible by deferring as much as we can, would you rather put away 32,000 into a retirement account or 9,000? So as we see, like, let's add another zero to that, and we can see that now the max limits are the same, right? So as your income continues to grow, that's where that SEP IRA allows you to do basically the same amount as what you can put into a solo K. But where we see people very commonly playing the game with this each year is just figuring out, one, how much did we earn in 1099, and which tax shelter allows us to defer the most money, right? So again, the solo K, there's a lot of good reasons to use a solo K. First and foremost, for people that are doing backdoor Roth IRA planning every year, if you do install a SEP IRA, that will become a roadblock. It become a tax conflict. If you have a SEP IRA and you're funding it with pre-tax dollars, you're not going to be, you could put money into non-deductible IRA and then convert it to Roth, could do that, but you're going to end up having to pay tax again on those dollars that you're converting over. So I think the benefit of the solo K that we tend to see is that you're able to put away more, or up to, you're allowed to put in more, and then it's a personal choice each year, but it also leaves the avenue open every single year to do backdoor Roth IRA planning outside of the plan. So
that's a great point. If you don't already have, deferred IRAs, deferred retirement accounts, why, butcher the opportunity to do backdoor Roths by funding a modest SEP account, right? When you can do a solo 401k and still preserve that.
Yeah. And we had a client, Matt, you'll remember this, that in 2023, they transitioned from all 1099 to W-2 in the fall. So leading up to the fall of 2023, they were all 1099 as a surgeon. And they were transitioning. And so we looked at, okay, what's the best way that we can use a max out a tax shelter this year, because they weren't going to be eligible to enroll in their profit sharing plan with the new practice until fall of 2024. And so we looked at all of their net earnings at the end of the year and ended up electing to use a solo K, and we're able to put away a lot more money, but they're still, at this point, just now, they've actually made their contributions, for 2023 retroactively. And so having that time, being that they're extending their return out, right, it was really helpful for them to, while they're building up their cash reserves, preparing to just kind of navigate comfortably into their new practice, it allowed them to know that they're going to be able to keep more of those 1099 earnings in their own name and pay less tax. So, and then in the fall, when they are moving forward, they're not going to have time to continue to pick up extra locum shifts, and their 1099 is going to be minimal to zero in 2024. And so all they're going to do is take that solo K that they just opened and just funded right now and roll it right into their future profit sharing plan. But it was just, again, it was like some gamesmanship that you look at every 12 months to figure out what's the best way to maximize our tax shelters. So that was a cool one.
Yeah, we had one pretty recently too, Jeff, where there was some issues on an IRA, and we had to balance out, okay, what is the timing of doing some distributions or converting the IRA into a 403B or a 401k, whatever it was, as far as rolling that, but then still having the opportunity to have the backdoor Roth. So all those different opportunities can get pretty complex on timing and what you can and can't do. So it's good to have Jeff in your court.
Yeah, right.
And you can still be maxing, like if you're W-2, you can still max a 403B and be able to put like a good amount into the solo 4. You can do both, right? There's no restrictions there. Correct?
Correct.
The restriction being if you already had an employer match, right? You can't get the employer match again on or your deferral. You can't have a deferral again. So you'd have to evaluate or look at your contributions on the 403B to see what did I already do because these retirement accounts are more or less the same, which that can potentially make it so the SEP is better in some cases because of the fact that you have to include those 403B deferrals and matches. So it really just depends on the situation.
Okay,
Yeah.
that makes sense.
Yeah, and it goes up to that cumulative max for, so again, like the client family that we were just talking about like 10 minutes ago, spouse is participating in a plan where she's actively working currently, but in the future, and the involvement with the medical practice will be able to kind of fill that gap between like the cumulative number in 2024 at 69,000.
Okay.
So he's maxing out, putting away 23,000 as an active participant in the plan at work, while also getting some of the employer match. And so then we're looking at the medical practice being able to fund the balance in the profit sharing plan. So it's just a really cool little thing. And yeah.
I think that's perfect. So we've tackled vehicles, employees on payroll, some retirement account opportunities. What do we have left here? About 8 minutes. What are some hot ones you guys want to tackle next? I got a handful left, but want to make sure we get the good ones.
Anybody in the audience want us to tackle one? I always feel like the Augusta rule is like fun, but don't have to do it.
That's what I was going to say. That is a good one.
Feel free, anybody, unmute yourself. You got others. Otherwise, we'll just jump into the Augusta rule.
Hi guys, Ricky, great presentation and great talk again. Just going back to the 1099 and the I think I'd asked before, I'm doing the mega backdoor Roth from my solo 401k. It allows for post-tax contributions. I know you have to specify whether it's employee or employer. So those post-tax contributions, if I'm making them, after the calendar year, it has to be specified like employer ER contributions, right? Because like for those post-tax, and then from the post-tax, you can convert to the Roth portion of the solo 401k, right? But you do have to specify, right, that it's employer. Like, or does it not really matter? Like, you guys know the answer to that?
I have my perspective. If you guys have your perspective, we see two different pictures on this too. So
you go ahead, Matt. You're the star of the show. So
from my perspective, as far as the IRS is concerned, it's really just a calculation on the back end that you do or you and your CPA do. As far as the deposit and how that gets made, it's all going into the same account. So it's not really differentiated. It can be differentiated depending on the institution you're working with, but it's not necessarily differentiated for the account. There's different rules on employee versus employer contributions, when it can be pulled out of the account and such. So it should be differentiated, at least in your regard, but it's hitting the same spot and doesn't necessarily have to be split between the two.
Is that helpful, Ricky?
Yeah, cool. Thanks.
Okay.
Yeah, so yeah.
That one's a little over my head, so I just deferred that to Matt. I had nothing to add there.
Yeah, the IRS has different rules on what funds you can access, even if it is a Roth account, because you can pull employee contributions differently than you can pull employer or access employer contributions. So that's where the differentiation comes in. But when it gets hit all in the same account, you really don't need to denote what the difference between the two is, whether it's employee or employer. Mm-hmm. Unless, for Roth accounts specifically, an employer match actually has to go into a deferred account. It can't go into your Roth account specifically. So those will actually go into two separate accounts in that case. So that might be where you're butting into some questions that are happening with, whoever you're working with.
Yeah, because it's the solo 401k is like technically in 3 accounts in order to do the mega backdoor Roth. It's the traditional solo 401k, which I'm going to contribute, the max, and it's like about 20% of my, business side gig income, right? But then make post-tax, not Roth, but post-tax, second account that's a post-tax part of the 401k. And then I'll do that to the max of, I think you guys said it's 69,000 or whatever. I also have a 403b which I max out with the employee, so that's unfortunately going to cut into. But anyway, and then the third account, that's the Roth, so that's what I'm really doing.
And in your case, you have the third account because of the fact that you're doing a conversion, so you're initially populating a non-deductible account.
Yep.
I have a quick question. This is Dan Fidel. I'm actually under my wife's account, but we both are independent contractors for ERG. So for over a decade, I've been putting into a SEP IRA. And then the first few years, we had also been doing a backdoor Roth. However, the tax rules had changed, and so there was aggregation rules that we would need to be paying taxes on our earnings for our SEP, so we stopped doing that. And we've, over the last decade or so, accumulated, money in that SEP. If we switched over to a solo 401k, would we still be subject to those aggregation rules, or would that SEP kind of compartmentalize itself away from that and be able to move forward with a structure that we'd be able to start contributing again into a Roth IRA?
Yeah, that's a great question. And I can give an answer on this one, Matt. You can let me know if I missed the mark on it. But in that scenario, I think it'd be worthy of exploring if it would make sense to, when you open solo K, if you were to both create a solo K, you just pick up your SEP, just roll it over into the solo K and bring that SEP down to a zero balance. And then you'd have no more, it'd be like removing a roadblock, just extracting the roadblock. Then you could pick back up. If you get that done inside of 2024, you could start doing some backdoor Roth IRA planning right away in 2024 again. Is that accurate, Matt?
That's exactly what I was going to say. Yeah. And then as far as any contributions, backdoor Roth contributions, you don't have to worry about the aggregation anymore, or trying to pull out pro rata, your pro rata pulling out your SEP and your backdoor conversions, because the IRS doesn't allow you to pick and choose what one you're converting, right? So you eliminate that roadblock, like Jeff said, by just moving that over to the solo 401k.
So it's possible to just roll a SEP into a solo K?
Correct.
Would you need to change, I believe I'm an S Corp right now. Would I need to change the designation of what type of company I am to an LLC?
I don't think so, Matt. What are your thoughts on that?
I don't think so either. I don't think it makes a difference.
Okay.
The one thing
that is a good question. I'm not positive on that. I believe you're not limited by that. There's just certain employee rules on the solo K. So you don't have any other employees, right?
It's just me and my wife.
Yeah. So I think that would be, maybe that's a good one for if you have a tax team or an advisory team. Great for them to be able to wrap their mind around the uniqueness of that situation. But of course, we could answer that question too if we were able to look a little bit more closely at what's going on kind of under the hood. But my assumption would be a solo K, or if are you both participating in the same SEP, or do you both have your own individual SEP?
No, we each have our own SEPs.
Okay. Yeah, it sounds like what you do is both create your own solo K and just pick up that SEP IRA bucket, pour it out into the new solo K bucket, and you'd be good to go. The one thing that would probably come into play, being that you've been making contributions into those accounts for some time, is The only material difference that might matter to you is that if the account balances are bigger than 250K, you'd be looking at filing a 5,500 each year for the solo K, but typically your tax team could be able to just knock that out for you. It's just one extra administrative thing, but worthy to do that in order to pursue getting back to our Roth IRA planning going again.
Yeah. Okay. Thank you.
Great question. Thanks for asking. I know it's 1:01. Where are you guys at, Jeff and Matt, on time? I got a few extra minutes, but if you guys got to jump, we can conclude.
I'm good for now.
Yeah, I think maybe a couple extra minutes. I think one really cool thing would be to just talk about the Augusta rule. Like, Matt, can you just like put that into a real life scenario? Like you got somebody who, utilizes
absolutely.
that each year just to say like, here's how it works.
Yeah, I mean, we can even use Dan's example here,
Perfect.
and say, okay, I don't personally, as a physician, I don't have an office, right? But I need to have professional meetings. I need Jeff to come over to my house, and I need my CPA to come over to my house, and I might even have business interactions with my wife, right? Quote unquote board meetings. So what I'm going to do is I'm going to pay from my S corp directly to me as an individual, and I'm going to pay rent for that usage of my residence. So we're going to have these meetings at my house, whether it's with Jeff, CPA, attorney, board, spouse, whatever it may be. We're going to document, the conversation we had on that day, how long we met for, and what the business purpose was. But ultimately, we're paying from the S corp to me individually a certain rental rate. And the reason you do that is because once you pay yourself individually, if you're renting your house out for less than 14 days, you don't have to claim that as income. But the S corporation got to write that off as an expense, right? So if you pay it hypothetically 10 grand for the year for renting out your personal residence for these professional meetings, times that by your 37%, you save $3,700 and you don't have to claim it as income. Now, the key here is you have to have an S corporation in order to do it. So Dan's situation is perfect for it. If you are 1099 sole proprietorship, you are not able to do that because it's considered a self-rental, and the IRS doesn't support self-rental. So there's self-rental rules preventing you from doing that, but S corporations skirt that. Does that make sense? Summarize it as quickly as possible and you get the gist of it?
Yeah, absolutely. And I would say for anyone listening, of course, consult with a professional versus trying to do this on your own as well. And don't take any of this as like formal direct advice. We always have to throw out some disclaimers.
I actually have a great tool, basically a template for summarizing board meetings or what have you, that gives you a template to fill out these meetings for documenting agenda, so to speak. So if anyone wants that, feel free to shoot me an email.
Yeah, I want one.
I'll take all the free templates you have. That would actually be great, because then we could get some of them sent out to everyone that registered too, so they have it.
Cool. All right. Well, that was a really good session. It's 1:05. Yeah, let's definitely, we'll try to get some more dates where we can do some more, whatever we can find that's relevant. We'll pull the audience again, right, James, and put together something that makes a lot of sense as we move our way into the second half of the year. We're already there, right? So maybe there's some cool things we can put together that would be relevant for closing out the year with maybe bringing some of these new ideas for deduction / entity structuring, bring it to life a little bit for people as we get closer to the end of the year. So that was awesome.
Sounds great. Yeah, we might need a part 3 even because we didn't get through all the deductions as well. So, but I feel like we hit
encore.
Another encore. But yeah,
Matt, thank you so much for joining us. It really, it means a lot that you're taking the time to go through this. It's really
thanks
helpful.
for having me. It was fun.
It was fun. Yeah, thank you so much, and thank you to everybody being here. Appreciate all of you.
And thank you for the questions too. That was helpful for us. Awesome.
Absolutely. And like we said earlier, or Matt, you want to give your email out one more time, just in case anyone wants to reach out to you with a direct question or for a free consult?
Matt.Barczak, my name on the screen there, at Raymond.com, REHMANN.
Okay, awesome. Thank you. Matt is an absolute wizard and has done excellent work for all of our clients. So I would encourage anybody listening to reach out to that dude because he's fantastic. Thank you all for being here, and I hope y'all have a great week and a great July.
Thanks, gents.
Thanks, guys.
Thank you, everyone, for your time.
Thank you.
I Am Wealth does not offer individual financial advice outside of a formal consulting agreement. Content discussed in the I Am Masterclass is not and does not represent financial advice, tax advice, and or legal advice. The intent of the I Am Masterclass is to provide extremely valuable financial educational content for free. For personal questions, we hope that you'll visit iamwealth.com and schedule what we call a free financial wellness diagnostic to assess the current state of your financial health and therefore help you and your family take control of their money so they can live a more meaningful life. So we'll see you there. I Am Wealth does not